Well, I guess we're live here, here at the Real Fridays podcast every Friday at 12:30, talking about all things housing, mortgage, and real estate, with our special guest, Cassidy. Not special guest. What am I talking about?
Every week,
one of the real anchors to this platform is Brock Cassidy, and Jeremy Potter, who's appreciate you being on time, and
look at us.
I know our special guest is late.
Great.
So
we're good.
We can put Jeremy on the hot seat until then.
Yeah, I know. I wonder if Taylor's having any issues, and if he is having issues, I don't see any emails from him. Maybe he's just fashionably late. I don't know Taylor very well. There he is. Hold on. There's Taylor. We were just saying, like, none of us know you very well, so it's one of those things where you being a minute late, we just didn't know what was happening. So how are you, Taylor? And he's stuck.
I actually had a little bit of audio coming in too, so I'm sure it'll be momentarily. Just getting it lined up right.
He looks serious and he looks frozen. Oh, there he is.
Hey, Taylor.
Hi, guys. Can you hear me?
Yeah.
We got you.
Cool. So, yeah, I've been in Google. I had a Google Meet.
Oh, yeah.
So was that best to see how quick we are on the uptake when, like, you're in Google and
That's right. Rick needs something to talk about at the outset of the show, and so he likes to make it about whether or not people are on time.
Well, I was too early.
I'm not
early.
I'm not making it about that. I'm just making an observation about how prompt we are for very important weekly meetings. I think we are live on Facebook, YouTube, and LinkedIn. I did figure out a way to promote this on Facebook, which enabled us to. I invited maybe 2,000 or 3,000 people, at least in my group, just to kind of play with it to see if we get some trailing sort of followers. But on this, but obviously excited to have you, Taylor. Just to give you a little feedback on this, Jeremy, Brock, and I started this. Obviously, we're all sort of industry. I hate using the word experts, but sort of experts in our own right. My focus is primarily M&A and retail, where I've spent most of my career, growing companies, acquiring companies, and just sort of leading the sales efforts, and establishing partnerships. Jeremy's a lawyer, and he's been he's been a real innovator, both in tech, both merging in my words, sort of the legal considerations and innovation, as well as just moving the industry forward with unique partnerships and integrations, and just a great visionary for companies. And then Brock is our sort of millennial participant here in this, and Brock's an amazing guy. He spent a good chunk of his career at Rocket, and he's been an advisor, a board member, and a real sort of innovator in his leadership with tech companies. And he runs chief revenue officer over at NewZip, which is a really cool real estate bridge between real estate agents and mortgage companies. Been very successful the last year. So they won the Innovators Award with Lending Tree this past year. So
cool.
But the format of this is pretty free flowing, as you can tell. We do have sort of key things we hit, but it's, and I sent you a picture of a hot seat, to your text, we'll ask you a lot about, what you're doing with, obviously Mortgage Lenders of America, but also about, Developers Mortgage. And,
sure.
But I'm just as interested in what your thoughts are in the business as a whole, not just necessarily, one particular thing or another. But so why don't we just turn it over to just market comments, as we turn the corner into the new year. What is the general sense? We'll start with you, Taylor. What's the general sense as you turn into January?
I don't know. Let's start with this. I'm optimistic. I think things are finally thawing, and it's funny. I live in New Jersey, and it's beautiful and sunny outside right now, and it should be freezing cold. Although the rumor is we might get some snow. We'll see. But it feels like spring is coming early physically, and it feels like spring is coming early in mortgage. I'm seeing new transactions that I wouldn't have expected to see right now. It feels like there's thawing. A lot of buyers seem to be getting anxious to get ahead of the buying season that have been kind of on the sidelines from high interest rates. I think that the shift in momentum on interest rates and the general expectation that there's going to be another 75 cut, I think that is prompting a lot of people to try to get in quickly and early and get moving before they start to see prices rise on real estate. So there's this kind of weird little inflection point, right, where higher interest rates equal lower prices on houses, and lower interest rates theoretically equal higher prices on houses. And there's a sweet spot where you get in with, lower interest rates before prices start going up, and nobody knows where that is. And I think people are trying to guess at it, gauge at it, and find it. I think we're going to see some early transactions. I think that we're going to see an earlier thaw than we normally see the spring market, and I feel good about it.
Yeah, Taylor, I think you characterized the sentiment the exact same way I would have. That's exactly what I'm hearing as well. I think the one big variable that you just mentioned that I'm still digging into because I'm curious about it is how far do rates have to drop to get people to move to open houses? So there's absolutely no question there will be enthusiasm and excitement from pre-approved or wannabe pre-approved shoppers when rates drop. Almost any drop will generate more pre-approvals and more excitement around shoppers. But then the question becomes like, how far do they have to drop to unlock somebody who's now ready to relocate, downsize, retire, etc.? And that seems to be the big variable to me about whether or not 2024 is like really exciting or just.
Listen, candidly, I don't really care if it's really exciting. I just want it to be exciting. Like a little bit of enthusiasm is a half a smirk of a smile will make me happy, considering what the last year has been like. And it really, from my perspective, it's the reversal of the direction that matters. It's that reversal, right? So we've been pointed south for a year. And if all we do is get turned around and pointed back north and start heading the right direction, then momentum builds.
Yeah. Well, what year do you think this is going to be more like in the sense of production volume? I've the way I've characterized this year is how it's been more like a 2000, potentially 13, 2019. And I don't think it's not going to be a 2018. Yeah. But if we land in 1.8, 2 trillion or so, that's actually pretty good territory. I don't think that's anything to be sad about at all. Unless you're burning cash and don't have enough cash to sort of make it to spring. But
I just said
what would you
I just said 2019. I just said 2019 to someone for some projections. So that's interesting you brought that up. That's kind of what it feels like. Yeah.
I like 2019. I think that's a good characterization. I mean, what the MBA says 1.95 trillion, I think, is the latest forecast. I think that was the MBA's forecast. It was somebody.
Yeah.
1.95. And when we did 2.2 trillion a few years ago, we were jumping over doing somersaults. So 1.95 on the heels of what the last couple of years has been like, I think is great. But you have to also put it into the framework of market share per loan officer, market share per company, because, we've watched 100,000 loan officers leave the business. And we're waiting on numbers, but we're going to get new numbers in about 30 days as all of the NMLS renewals start to flush their way out. And God knows it's going to be more than the original 100,000 that we saw in 2023. So the market share is going to open up for those that are still here. So 1.95 trillion is not a bad number. It's a good number.
Well, especially with the number of loan officers, because I think back in 2019 we had about 100,000+ loan officers in the industry, and so if we're around 80. 85, 82,000, 83,000, whatever those numbers are, potentially lower. The loan officer to close loan ratio is going to be really, really solid. So your market share comment is really spot on.
I mean, at the end of the day, loan officers need to make enough money to pay their bills, house their families, feed their children, right? Of course, we want everybody to be, 7 and 8, 9 figure gazillionaires. But the reality is that this is a job where we earn our livings and we provide, right? We provide for those that depend on us financially. We provide for borrowers to be able to get their own families into houses. And we haven't been at a level of subsistence where we could do that consistently for about a year. If we just get back to that, then we can build off of that. Then we can grow off of that.
We got a shout out. You got a shout out from Brian View from
Thanks.
from
What a
I'm
star.
drawing a blank.
2 stars.
What's his company again?
FinLocker.
FinLocker. I can't believe I drew a blank. Sorry, Brian. FinLocker, and but no, super happy that Brian is watching. He's a faithful follower of what we're doing, and we certainly hope that he shouts us out to his 30,000 or so LinkedIn followers. I think that'd be great. What else? So what else are you seeing? Go ahead, Jeremy.
Yeah, so I had a question. Yeah, probably the same direction you were going, right, Taylor? Like, if the number of loan officers is an indicator, let's say after this month, is there another indicator, call it before Fed activity, that you'd also be looking at? Like, what else are you looking at that says, okay, I'm going to look for this number, I'm going to look for this thing, and then obviously Fed activity, kind of chronologically in the new year? What would be something else you're expecting to happen or shoot a drop? What should we be thinking about?
Yeah, I got to tell you, so honestly, most of my focus tends to lie in the policy space more than the economic space and the forecasting space. I will be the first to tell you I'm not an economist. I leave that to our friend live from Corona. But when it comes into some of these topics and just kind of off top of my head, I think we got to watch what happens with core inflation. I think there's a lot of people that are worried about the potential for deflation, which is a unique, scary thing. We're seeing things happen in Asia, specifically China, that we think could spill over and potentially infect us, largely because of the amount of money they put into our mortgage-backed securities. You got to remember that foreign countries are large buyers of United States mortgage-backed securities. In fact, the whole Ginnie Mae team was in Asia, I think about a month ago, doing an investor tour, selling the concept of the American Ginnie Mae mortgage-backed security. And Rick, you probably know this better than anybody, but if we don't have large organizational buyers, specifically sovereign countries in some cases, China, Japan, and others, if we don't have large companies buying our securities, that puts pressure on price at the secondary market level. And that pressure feeds directly through to the primary market level, which is basically our rate sheets, right? And that's why it's a large part of the reason why we've had a crazy spread over the 10-year. Was that there just wasn't appetite to buy the securities themselves. So I think to answer your question, I don't have a specific number or specific date, but my focus would be on whether international buyers, institutional buyers, and whether independent foreign sovereign countries are investing in our MBS product. That's the big thing. I think the other big thing to watch, candidly, is what happens with some policy things that are going to influence whether banks are investing in the MBS. Basel Endgame 3, a lot of people don't even really understand what it is, but fundamentally, if banks don't invest their capital or reduce their capital investment into MBS holdings to protect themselves against events like Silicon Valley went through, or MSR holdings, that also puts pressure on the price of the bond, which feeds all the way through to our rate sheet, and that makes it harder for us to do loans.
Yeah, the capital treatment, I think, is one of those levers that affects everyone, but doesn't get a lot of attention all the time necessarily. And you're exactly right. How risky you treat things and how you incentivize banks one way or the other around risk and the investment of risk. The irony for me around the Silicon Valley stuff, I think the mainstream media hears bank failure and that's the story. But the idea that there was a bank failure for being too conservative, like that never got said in those words, but that's how it was that's kind of how it came across my desk, which was
I
like,
think that's because the Silicon Valley part of the name, right? People assumed that they were doing something super risky,
super risky. And it's like, no, it was the opposite. It was long-term stable income investments.
Basis risk.
And it was like too many of them.
That's the great irony.
Yeah.
That is the great irony. These, and look, I did a whole series of webinars and analysis right after that happened with Dave Stevens and a few others. And we tore these things inside and out, upside and down. And there were certainly mitigating factors and, tertiary things that caused issues. And Silicon Valley Bank did some weird things with how they, distributed capital for investment, and then how they made people keep their banking accounts there. But outside of all of that stuff, the big picture was they owned mortgage-backed securities, and the mortgage-backed securities were marked to market, and that was a problem, fundamentally. So it was driven by Fed action. There's no two ways about it.
So if we control for like a normal amount of demand on the RMBS, the typical amount of demand from the RMBS internationally, and we control for the fact that Fannie and Freddie money is still the money in the market, what's going to happen this year that, divides winners and losers in our industry?
Great question. So I'll tell you what I'm particularly concerned about. In 2022, the FHFA and Ginnie Mae announced the risk-based capital structure for non-banks, the new capital requirements. And if you remember, a handful of us fought back really aggressively on a couple of items. One of the items was that they were going to impose a 200 basis point cash set aside reserve for hedged pipelines, which, if you know how the math works, 200 basis points is at least 4 times too much.
Yeah.
If not more than 4 times too much. So we fought hard against that. We got that cut down and then reduced. And then we got exemptions for small lenders that it really doesn't impact. What we didn't get done, at least we didn't get finalized, was the actual risk-based capital ratio itself. That can got kicked forward, and that can comes to a deadline in December of 2024. So we've got 11 and a half months to address a risk-based capital ratio that we kind of forgot about after Ginnie Mae said that they would put the pause on implementation of that reserve. Now, you have to understand that reserve is going to impact how servicers choose whether or not to retain Fannie Mae, Freddie Mac, and Ginnie Mae servicing rights. And if they choose not to retain servicing rights, that they have to sell them to not retain them, right? And as soon as you start selling stuff, pricing models change. Kezian and Smith and all the smart economists, all their theories kick into play, and demand and supply go to work. And what happens? We watch those numbers pass again from the secondary market to the primary market, straight to the rate sheet, to the customer, to the transaction. So the same challenges and concerns we had a year ago, we bought a year, and now that's kind of one thing that is on my mind is what happens on December 31st. I think long before we get there, we got an election. So there's going to be all kinds of weird, wacky stuff that happen politically.
Yeah.
The election.
Well, I was just going to say, what's the bandwidth to actually getting that done? More than likely, that's probably going to get kicked again into 2025, wouldn't you think?
I hope so.
Yeah.
Somebody has to decide to kick it, but I hope so. Basel III endgame is the other big kind of thing in the room. I think Basel III is getting a lot more attention than the risk-based capital piece, and for good reason. When you talk about how some of the public policy impacts the banks, now what you're really doing is talking about how it impacts cash, right? Because banks are cash. That's where we get our money, most of us. So I think that your big three are the election, Basel III endgame, and the revision or the resurfacing of the risk-based capital ratio concern.
Mm-hmm. One of the things that Rick mentioned at the outset was your involvement in the Community Mortgage Lenders of America, CMLA. Yeah. So is that banks as well as mortgage lenders? Oh, wait, association?
CHLA, Community Home Lenders of America. That's all right. Don't worry about it.
I want to get it right.
Home lenders. I messed it up.
Okay, you don't always have to get all the names right. And Brad will agree with you.
Right on. So what's the makeup of that group? So is it because that Basel III, obviously depositories, yes, with the rule you just mentioned being focused on especially independence, sounds like you're work covers both. Is that?
Yeah,
Tell us a little bit about that.
It certainly bleeds over. We do have associate members that are depositories. CHLA is a trade association and advocacy organization that focuses on independent mortgage banks, generally on smaller to medium-sized privately owned independent mortgage banks. Those organizations have a very unique subset of concerns and needs, and we work hard to advocate on their behalf in all areas. Now, having said that, those organizations need banks. They need banks to buy their mortgages. They need banks to lend them capital to make their mortgages. They need banks to go deposit their, paychecks into and all the other things. So the ecosystem that we're all in is uniquely tied together. So Basel III Endgame has a direct impact on independent mortgage banks, because if those depositories choose to change their business models, it directly impacts an IMB that depends on that business model.
I appreciate that. I'm pausing because I've dominated the conversation, and I wanted to make sure that, Dr. Rick has his opportunity, but otherwise I'll keep going.
No. Well, I was going to say, I'm curious just to understand the makeup in light of, so it's just an industry association like the NBA or but it's not a collaborative. It's not a collaborative like Lenders One or Mortgage Collaborative or.
Correct. It is not a collaborative. It is a trade association. So it would be characterized similar to Housing Policy Council for larger institutions, or ICBA for community banks. Trade association for credit unions. There are a few different trade associations that have very specific representative interests. And as a rule, most of those kind of smaller trade associations collaborate. And we often are all in collaboration with the MBA directly as well. In fact, there's a joint initiative right now focused on making sure that a component of the a component of the federal budget called FUD gets passed so that Ginnie Mae and FHA have appropriate funding so we can all keep making government loans. And the trade associations are all kind of jointly working together, arm in arm, which is a great thing. We do a lot of joint work with the MBA, with ICBA, with HPC. We have our own, there's a number of areas where, look, we're all here to put families into houses, right? So there's a number of areas where everybody's interests are completely aligned.
So why is it that does the MBA just not service this particular segment of mortgage lender, or like why I'm struggling with why there's the need for it when that's in essence, or is MBA more focused on policy and legislative sort of lobbying, and this is more of like an in the trenches kind of association amidst peers, like of a smaller cohort of lenders?
Yeah, what I would probably say is that the last part of your statement is the best way to describe it. It's a smaller cohort of lenders with unique, very specific concerns. And I'll give you some examples. So one of the things that CHLA does is we try to ensure that we come at issues from a kind of a consumer point of view, right? So we came out with our list of the Consumer Bill of Rights, and I'm happy to shoot that over to you guys. But in our Consumer Bill of Rights, we said things like the consumers should have the right to have fair pricing for their credit reports and their FICO scores. And this was during a period of time when there was a pricing model that meant that depending on which lender you went to, you might get different pricing for a product that is ostensibly required by the federal government by virtue of the fact that the federal government owns, operates, regulates the GSEs, right? So that was one issue that the organization took up. Another issue that the organization took up was related directly to that non-bank capital ratio concern. We were the ones that leaned in hard on the reserve requirement for hedging pipelines. It doesn't impact large lenders the same way that it impacts small and medium-sized lenders. So in a number of cases, we take up nuance nuance items. In some cases, we band arm in arm together on bigger picture items. What I would tell you is it is also an organization that is very democratic in process. So we have a very high level of member engagement. Our folks go to Washington, D.C. and personally meet with the heads of different agencies. We personally meet with, and this is whoever wants to go, from Director Thompson to Director Chopra to other various policy heads. We meet directly with the Senate Banking Committee, House Financial Services Committee, and we talk through issues like the fact that suddenly soft pull credit reports are no longer a functional, viable option for lenders to use to support their customers. It's probably the best way I could put it is it's a trade association with a twist on it that is very not only advocacy based, but also consumer based in all of the endeavors.
Now, do you publish how many members you have? Or
we don't publish our members and our membership, but we do on our website. We publish all of the different initiatives we work through, all of the different letters we send. We recently reached out to the federal agencies and told them that we are concerned about the potential ramifications of the Stitzer lawsuits, and that we are specifically concerned about VA loans, because as you know, a VA loan does not allow a veteran to pay a commission to a realtor. Right. So in theory, that is something that the VA can address through rulemaking. We're waiting to see that happen. But the impact of this slew of lawsuits that are working their way across the country, a lot of the impact is still kind of unknown and unmeasured. And so we decided as an organization that we wanted to draw some attention to the nuts and bolts, real life potential impact if one of our veterans is unable to exercise his benefit or her benefit from having served their country. And we think those are the kinds of nuts and bolts things where we can roll up our sleeves, get involved, make a lot of noise, and draw attention to issues that impact actual borrowers.
Yeah, we've talked about both those. The two of the things you hit on quite a bit here. One is, the sort of pressure on the middle of the market. So for your membership, if you're small enough, that means you also tend to have lower cost overhead and you can kind of be a little bit more nimble in these times. And if you're large enough, you've got the reserves or you've got the forecasting that helps you navigate 2023 or whatever is ahead. And the middle actually has the worst of both, the larger cost structure and the lack of resources. And so we've talked a little bit about the threats to that tier, which falls right in your membership as you were describing. But the sort of discrete thing for 2024 that's most interesting is, what does the primary market do with this lawsuit? And to your point, what unintended consequences, if any, does it have? I mean, I think one of the things I'm excited about is forcing the primary market to make decisions about value. That this will actually say, what do we need to do? What does a veteran need? What does a first-time home buyer need? What does a commission structure look like when it's allowed to be whatever the homeowner or potential homeowner or whoever decides they find value in it? So I think the amount of ideas being thrown into the market will be part of the story for 2024, but then which ones create will be the other part of the story. I
agree with you. And I think so it could turn out to be much to do about nothing, by the way. And we all need to keep that in mind, because it was one lawsuit and there's going to be 50 more, if not 100 more. And some of them are going to go the other direction. And then it's all going to go to circuit courts, and circuit courts are going to go to Supreme Courts and a Supreme Court. And then on top of that, you have the potential for states to pass legislation themselves and create their own set of rules. So there's a number of ways this can go. We don't know yet which way it's going to go. Our concern is not whether this is kind of the end of the real estate business as we know it, or just a little blip on the process, but fundamentally that this brings up a good point in time to ask ourselves whether a veteran and that veteran's loan product should consider a commission structure as part of a closing cost, because right now we just don't consider commissions parts of closing costs, right? We don't do it in any of the loan programs. And so therefore, they aren't eligible to be paid by down payment assistance programs. They're not eligible to be financed through secondary programs through lenders. There's a lot of restrictions that have just never been contemplated because we didn't have to, because it was always rigged into the overall sales price. So that's one area. The other area.
Well, let me stop you there. Do you think that kind of prolongs the inevitable in some ways, as far as just getting rid of the commission altogether? I mean, in the process of trying to streamline through just better use of technology and connecting with buyers with sellers, is it a role that we should have to facilitate or sustain the real estate commission at all?
Yeah. So, what I would tell you is I believe in market economics. I don't believe in a model where we decide what the model is and how it should work. The model's going to play itself out. Buyers and sellers are going to decide how they want to be represented. And maybe some of those are going to say, I don't need to pay a realtor commission. I'm just going to put it on Zillow and wait to get an email that says that I've got an offer from somebody and I'll accept it. And maybe that works. Maybe there's going to be a model where you can just click to buy and put it in a cart and, a house shows up in your name. I fundamentally believe that the market is going to decide what's going to work, not a bunch of smart people that have the best idea. The crowd-sourced information is going to decide what works best. Our role is to be ready to support it and finance it. And people in
well, I think providing lenders with the flexibility to be able to underwrite the cost would be a big advantage.
Yeah.
It might address some LO comp issues too, but that and pricing strategies around that. But that's pretty interesting. I know that we had some email exchanges around some thoughts you had on the subject. I just wasn't sure what if any of that was public that you wanted to share, or is it something that was more private?
Yeah, so we published our letter and we sent it all over the place to every agency that we thought was appropriate to receive it. It's pretty well documented. It went to the House, it went to the Senate. We got some feedback from various people in both chambers. And, I think that this is going to be an ongoing conversation. But fundamentally, at the end of the day, we need to ensure that our population has the ability to finance and then purchase homes. It is the American dream. I mean, there's a reason we call it that, right? So we have to have the mechanism in place. And that is a fundamental baseline issue. We just have to be able to support it.
Who's your closest ally, would you say, in the what representative, either in the Senate or the House, do you think is the closest ally to the mortgage business and housing as a whole?
Oh, wow. Rick, you got me stumped. I don't have an answer. I can tell you that Senator Reed out of Delaware just authored a revision to the trigger leads bills that we have decided to support. The original bill came out from Torres and was going to end all trigger leads, and we thought that was good. And then Rose came out with an alternative bill that kind of ended trigger leads, but had some special interest carve-outs and some special interest language that kind of kept it for some people. And we weren't super supportive of that special interest language. With the Senator Reed bill, they reached out to us before they published it, and they showed us what they were doing, and they sent it over, and they said, we'd like your support on this. And I read it, we all read it, and we thought it was good. So I don't know. That's my best. I mean,
if that's a hard question, what about who do you like the least? I'm kidding.
Amazing.
Definitely don't answer that question. What? Go ahead, Jeremy.
Well, I think
what's the guy's name that just got kicked out? Santos. That's who I like the least.
Easy, right? Somebody who's not in the job anymore. Yeah, I mean, I think you make a really key point that I've been thinking about a lot, which is if the federal, you mentioned it particularly around the fees that a consumer pays relative to what's required. The federal government owns Fannie and Freddie. They run Fannie and Freddie. Fannie and Freddie require this. So how can we have an uneven playing field relative to who gets what? Yeah. And I think kind of in this space, there's there's this really tough question that will affect the future of housing, which is, does the legislature move on some of these key issues, and why? Does housing become a priority, and why? Because otherwise, we're looking at a decade of stagnation. And what I mean by stagnation is the same old, same old. Fannie Freddie money costs what it costs. We market that. People get whatever homes are available on the listing or not, whatever that listing even looks like, Zillow, MLS, whatever. And so we're kind of bouncing between big picture and practical. And like tactically speaking, if the legislature isn't going to understand housing or move, we're basically set up to just be storefronts for Fannie Freddie money for a decade.
And that's what we are. So, I think that you bring up a number of good points, and there's a number of concerns. I would argue there is no cohesive housing policy right now, because when you look at things that are coming out of one side and things that are coming out of the other side of the federal government, often they're conflicting with one another. I mean, if you look at the repurchase issue that we've been talking about now for a year, and compare that, and a lot of that's appraisal-based issues, and compare that to the PAVE initiative, which is under the direction of, I believe, Marshall Fudge from HUD, and you look at those two things, and they conflict with one another. When you look at the recent White House announcement on AI, and you look at the efforts by the FDIC and the CFPB to rein in the process of appraisal management, and then you compare that to some of the policies that we work through with all the different agencies, and those things have some conflicting issues. So when you look at housing in general, and then you can get really, really big picture and say that if you're going to raise interest rates to 19%, you can't possibly say that you support housing, right? I mean, that's kind of obvious. So I think that it's fair to say that this administration would love to say that they have a policy on housing, but I don't think it's cohesive. And I think that a lot of that is going to come to bear as every single political position that is up for election, applies for their next position and to the voters. And remember, when cabinets change, when administrations change and the cabinets change, so do a lot of the bureaucratic positions. And so one of the big challenges for all the trade associations is trying to figure out what the policy is going to look like, post November of this year as well, and who's going to be running it.
Yeah, and I think you're right. Like I've been I've wanted to do some of the historical research last 10 or 15 years, but I don't think we've had cohesive housing policy since the crash, really. Yeah. We've had low rates that generated refinance activity that sort of was a cover for having to do anything meaningful around true housing policy relative to home ownership as an economic driver. Yeah. And I think that's what I don't hear enough about is home ownership as an economic driver. Like your members are potentially economic stimulators to the local community if we were to look at housing that way. We talk about it that way when we talk the rhetoric of the American dream for the last 50 years at the political level, and we know it to be true, or we claim to know it in the industry, but I haven't seen true economic policy that honors that or respects that, at least as long as I've been in the industry.
I think we take housing for granted, and we have for a long time. If you look at CPI, 42% of CPI is housing, right? The biggest number that we use to measure inflation and to measure how our economy is doing in general is housing. And yet we really don't have a cohesive housing policy. We got 500,000 Americans that are documented that are homeless right this minute. And we have a huge swell of Americans that would love to buy a house, but can't because it costs twice as much today as it did 12 months ago. We have a cohesive housing policy.
Yeah, I heard something this week I'll throw out there, Taylor, for you on that. I'm not strong on my economic bona fides either, as we were talking earlier, but I was listening to someone talk about GDP, and it was from the individual that created GDP as a metric many years ago. And the quote at the time was we should use this, we should look at this. But remember, it doesn't tell us if the number of economic transactions, the number of the type of economic activity in the country is the type we want. It will tell us the volume of economic activity, the volume of economic transactions in the economy, but it doesn't speak to, are they the ones we want? And I think we've gone away, the point you just made, we've kind of gone away from saying, hey, is this the type of GDP we want? Are these the types of transactions? We want to generate economic activity, no question, but not economic activity without an intent. I think the intentional, like, we want these transactions, we want this type of economic activity is where we kind of get lost. And we're just using this macro GDP as like, as long as it keeps going up, well, are they the ones that are helping for success, or is it just generic economic activity? I think you're spot on in terms of like pinpointing, like, how do we talk about that better? Because we're not talking about it well as an industry.
But the industry's been in defense, for a long time, in reaction mode to try to, I mean, I don't blame the industry or even, administrative officials, both at the tail end of Bush and going into the Obama administration to, because when you're trying to bail out, in essence, trying to figure out what to do with the foreclosure crisis, I mean, that took what, 3 years to sort of work itself through?
Yeah, 9 to 12.
2011, 12. And then it was all the regulatory reforms of the CFPB was launched, in 2013, 2012, 2013. Yep. So, I mean, it was just constant, regulatory offense and then industry defense. And then there was just no housing policy underneath it. Probably the last cogent sort of housing policy would probably be under the Clinton administration, where they made it, a real centerpiece of their policy goals as a platform.
Yeah.
We could argue, to your point, Jeremy, we could argue what was the intent behind it, and whether or not the intention was correctly aligned with sort of sound economic policy, because obviously a lot of people think that, and then there's a good basis for it to say that a lot of those policies are to blame for the run up in 05, 06, and 07. But to your point, there's, from a policy standpoint, and how do you innovatively restructure new products to actually meaningfully help Black and Brown communities, meaningfully help veterans, meaningfully help people who don't have down payments? Is there ways of through just structured finance, like policies that support the structured finance of the mortgage itself to enable home ownership in a more meaningful way? I don't know. I mean, and then there's the housing pieces. Yeah.
It's what we're not good at, holistic thinking. We're not good at holistic thinking. Builders are separate from real estate, which is separate from mortgage, which is separate from taxes and insurance. And it's like, this is a holistic thing to the consumer. But to your point, we're not building a story that goes across all of that, and why the policy should be what it is, and why inviting more people to the table to access housing in an equitable way has this massive economic effect on the country in a positive way for everybody. Like, it seems like we don't talk about it holistically.
We don't. And that's exactly why we sent that letter on Stitzer, because that was an opportunity to say, hey, look, you got this weird situation. Let's look at the whole picture and figure out how to solve that problem. A few months before that, we sent a letter to the Treasury, Department of Treasury, and to a few other agencies, and basically said, that the spreads are too high and that you need to fix it. You need to figure out why, and you need to put together a policy to address it. We were very aggressive on that. And to your point, this is why advocacy is important, because, Rick, the creation of those products, that's okay. Maybe that's going to happen through PLS activities, but the reality is PLS activities don't usually lend toward the borrower segment you just referred to. The borrower segment you just referred to are usually financed by loans that end up purchased by Fannie Mae, Freddie Mac, and are insured by FHA, USDA, and VA. That's where the $200,000 and $300,000 and $400,000 loans go. And so that's where we have to make a lot of noise, communicate, share, and work cooperatively to try to make sure that those categories, those groups have the kinds of products that are innovative, that do open up the marketplace.
Right on. Hey, Taylor, thank you for your time. I got to jump, but Rick, Brock, thank you. It's great to be connected. I look forward to talking to you very much in the future. So take care. I'll let you guys speak,
No,
but
that's okay.
I gotta leave. Take care. Right on.
Just in closing, as we wrap this up, what would you say to be, and I think you've touched upon this a little bit, to be some of the priorities, if you were, Chairman Stork of the NBA, what would you say? How would you leverage the NBA, for instance, in its policy, in its priorities moving into 2024?
Well, so that's an interesting way to position the question. I'm going to answer it differently. What I'm going to say is, if I were President Stork of the United States, a big, huge stretch. I think housing policy would be front and center. I think that all of the trending, I think that all of the trade groups, and I think that all of the lenders need to stay focused on ensuring that we are pressing back on multiple layers of competing legislation that interweave and overlap from state to state. So here's one of the biggest challenges that I see, and this is where a cohesive national policy, if you go state by state by state, there's different rules in every state, and our lenders generally operate in more than one state. And it never ceases to amaze me how often I stumble across a regulation in one state that is literally at odds with a regulation in another state, where you have to choose which state you're going to adhere to. It happens on a regular basis. I think that one of my main focuses would probably be focusing on ensuring that the policies and the regulations state by state by state are examined and are sought to be kind of complementary to one another. The other big issue is the actual NMLS system itself. Fundamentally, the CSBS operates the NMLS. There are some things that can be improved upon, and it could be a little bit more streamlined. But if you take the technology out of the conversation for a second, LO licensing, LO licensing is a difficult thing to address. Under the SAFE Act, all loan officers were supposed to be licensed. There was some nuanced language that allowed for discretion on whether the CFPB applied that licensing requirements to bank loan officers. At the time, the CFPB chose not to. And so as a result of that, loan officers that work for depositories are not covered by licensing requirement. And the theory with that was that banks are held to a higher standard on their hiring practices in the first place under, I believe it's Section 19 of the FDIC's regulations for what allows somebody to be a bank employee. Well, the FDIC is currently reviewing Section 19 and reviewing and considering a rulemaking to allow ex-felons to now become bank employees, which would theoretically put ex-felons into a mortgage division and originating mortgage loans, which is kind of at odds with the theory that loan officers don't need to be licensed and have federal background checks done. So, there's a number of different things that are all going on, and these policies are not cohesive, really is kind of what I'm trying to get to. There's a lot of competing policies. We've got states that have rules that compete with one another. We've got policy at the state level that doesn't really jive with policy at the federal level. And those are the things that I think a lot of effort can be put into to advocate to ensure that fundamentally customers should be able to depend on who they go to get a mortgage.
Yeah, it is pretty interesting. The licensing piece is more systemic and kind of behind the curtain from a policy standpoint, but it has, pretty dramatic implications to, the barrier to entry into the industry. And not to say that there shouldn't be but I think there should be greater latitude for mortgage companies for, the training of it. It is interesting because depository loan officers within our sphere tend to be the worst loan officers, the least knowledgeable, both in sales and in product. And so it's kind of an inverse of what is actually happening in the trenches versus what's assumed from a policy standpoint. There's certainly some good ones, but for the most part, I think the lion's share of the talent exists in the non-depository space. So it's an interesting. That's a really interesting comment. I'm pretty much out of questions for now. What do you think, Brock?
No, this sounds good. This is not an area that I'm particularly knowledgeable about, so I think I'm learning a lot. Like it sounds like a lot of the people listening today are. So yeah, I don't think I have a ton to add here. But going back to I guess the very beginning, I really like this moment in time where it's and it might really help us out that it's an election year too, where everyone's going to be trying to get some all the officials are going to be looking to gain some favor with key industries like housing. But I like this moment in time where everything's sort of turning. Everything's getting a little more hopeful going into the new year. I was talking to a friend who's a venture capital investor last night, and he's like, "This is one of the best times for us to raise money and invest in startups because we're kind of getting the fear of missing out train going." You mentioned earlier, Taylor, that everyone thinks prices are going to start going up on homes right now, but there's this moment in time where it's a perfect storm of rates are coming down, home prices haven't gone up. So I'm hopeful. Obviously, there's going to be a lot of complications this year, but I know we wanted to talk at one of the next shows about whether innovation and kind of M&A in the space is going to be affected by the economic factors. I'm getting a lot more bullish on more industry investment, more both from existing companies and from outside the industry. It's a really good point about licensing loan officers, though. I hadn't thought of it that way. So I did want to ask one question, I guess, Taylor. Do you think we're going to need to bring a lot of new loan officers into the industry this year to support demand, with so many having left?
Yeah, I don't think so. To be honest with you, I just don't think so. I think that to your point about technology, there's been a lot of technology innovation. And I hope that we're going to see that technology enables us to start bringing down the cost of origination instead of increasing it. We've watched, look, for the last 20 years, the cost of originating a loan has just marched up and up and up and up and up. And I've talked about this openly. I think it's a shame that many of the third-party services providers are, I shouldn't say it this way. What I should say is I think it's a shame that mortgage companies are losing money or have been losing money for the last year, left and right, while the third-party services providers have not, and that some of that has been at the cost of the expense line item for the mortgage companies in the first place. Yeah. I'm hopeful that this year that starts to turn the corner, that technology begins to become an asset. And
cost efficiency, not such a liability.
Yeah, exactly. And theoretically, good technology ensures that the average loan officer can do more loans than they used to do, or the averages increase, I should say. What that does is it enables us to deliver a better product to a customer. It allows us to do it at a better cost. And fundamentally, it lets the individual loan officer earn more income if they can do more transactions. So I don't think we need more people. I think we need to concentrate the business on the people that we have.
Yeah, the same with real estate, with the Pareto principle, right? Where it's like the best 20% of loan officers or real estate agents are going to be good at adopting the right tools, are going to be good at adjusting, and they're going to keep eating more of the market. I mean, so I'm with you there, but it'll be. I mean, the loan officers that have weathered the past year deserve some upside. So hopefully it's a favorable year.
Well, good. Well, thank you. I appreciate you joining us, Taylor. This is great. Good to spend some time with you, and I look forward to. Are you going to the IMB conference? You must be, right? Yeah, I'll be. I'll be there as well. Are you speaking?
I am not speaking.
Got it. Yeah, I'm speaking on Wednesday, but I'll be there on Sunday, and then I'll be leaving on Wednesday. I think Brock, you're going to be there as well, right?
Yeah, I'm 90% yes. Haven't booked it yet. Need to, but planning on going. I know Jeremy has booked it. Jeremy's going, so we'll have this whole gang there.
Cool.
Good deal. Well, thank you again, guys. Appreciate it. Another Real Fridays. Talk to you soon.
Bye.